All right, well, let's get started. We're gonna have an interesting conversation today. Based on the registrations, we have a really interesting set of humans on this call. Um, Many C-level executives, many revenue leaders, many CEOs, and the conversation topic lends itself to that audience. So it's not an accident that you're on the call. We have been through a couple of years that have been tough and confusing and different than the building environment that we all built in over the last decade. These last 2 years, some things just didn't work the way they used to work. So the way that the way that we built our go-to-market machines all of a sudden started not producing the way that we were used to. And so we're going to have a conversation about that. And I'm going to try to turn this into a conversation, not just a broadcast, because I think we have a lot of interesting insights on the call here. So I'll try to monitor the chat. Sari, if you can help monitor the chat as well, maybe call out something that I don't see. We will we'll try to keep the conversation as active as possible. And if we're not noticing you, I don't know, raise your hand or hit the little thing on Zoom or whatever, or pipe up in the chat, whatever. So we have experienced some interesting dynamics. You may have seen this in the marketing for this conversation. We've divided the conversation today up into, are you seeing the correct screen? You're seeing me, or are you seeing, I think I need to change which camera.
We're just seeing you right now.
You're seeing me. Okay, hang on one second. Why do I not know how to do that? Oh, I know how.
I could also, here, let me spotlight you. That could solve the problem.
No, I think it's this. How's that?
Yep, looks good.
Okay, good. I just couldn't find the button. Okay, so we divided the conversation into two acts. What happened and how do we get here? And then what do we do about it? So let's talk about the data. Some of this data is going to look familiar, and I'll be curious, and we're going to take a poll on this next slide. So we've been watching public and private companies over the last several quarters, over the last 2 years, from second quarter of 2021 until Q3 of 2023, which is the most recent data we had when we ran this. And we saw the cost of acquiring net new revenue increase from 150%, so spending $1.50 for every $1 of net new revenue, to 264%. So now spending $2.64 for every $1 in net new revenue. That's all net new revenue, meaning expansion revenue as well as new customers. Any net new revenue above and beyond the attritions that have happened, $2.64 for every $1 in net new revenue. So, question for you. Is this due to macro effects, meaning effects in the economy that have caused buying to stop, like demand drying up? That would be A. Think about your answer, and then I want you to put these into the chat, A, B, or C. Is it due to micro effects, meaning the actions that we're pursuing, the go-to-market motions that we're pursuing are no longer effective? So the demand's there, but we're not meeting the demand in the right way, or C, both? So just type in A, B, or C in the chat. Just see what you guys are seeing in your businesses. Okay, almost all C. Actually, I see only C. Macro and micro, both. Demand drying up due to macro conditions and buying slowing down, and also not meeting demand where it is, even when it's there, because our motions have stopped being effective. We got 1B. There we go. Ahmad, thank you for being brave. Okay, so we clearly we're seeing it in the data, and the and paying $2.64 for every net new dollar of revenue is painful. It's painful, when we have to pay that much for growth. Something is happening wrong, but at least we're getting the growth, right? Wrong. Even worse. We're paying $2.64 to chase growth, and we are not getting the same growth that we used to get. Growth rates have actually gone down on average to less than 20% for SaaS companies. I've seen various studies on this. This is our data, but mid 30s at the high, now down to 18% at the low. So not only are we paying too much for it, we're not getting what we used to get. I am guessing that people have seen this in your business as well, because we have seen it across the board. This is not just net new, Raphael. This is all ARR. So we're all revenue, actually. This is all revenue, which was a normalizable figure. So this would be net of attrition and include both expansion and net new. So as we saw this, we've got spend going up per dollar of net new ARR, of net ARR increase. We've got growth rates going down. So even though we're chasing it with $2.64 for every $1 of new, we're still not getting the same growth that we needed to. And we were left with no options. Basically, we had to stop the bleeding. And so we went into cost mode. And we started cutting costs. And so we had a wave of layoffs. Well, this shows the layoffs from the beginning of COVID, but then beginning of 2023, we kind of peaked, but all through 23 they started, and then 2024, we are still doing layoffs, both on a per company basis and a total employees laid off basis, trying to get our costs in line so that we're not overspending for the growth we're seeing. And the good news is that actually we got a handle on costs, and we got free cash flowing again. These are just public figures, but free cash flow is back up in the double digits for public SaaS companies, 11%. Anybody happy about that? It's good-ish, right? Like, I mean, free cash flow, okay, fine, but growth rates declining and free cash flow on the way up it solves for half of our problem. Okay, so Sebastian, this is all publicly traded SaaS companies. We did correlate it to private companies that we have access to, whose data we have access to, but we didn't incorporate our private company data into this because we wanted it to be clean. So this is all publicly reported SaaS company data. All right, so we're overpaying for growth. We're not getting growth. We cut costs in order to get free cash flow back, and we got our free cash flow back. So now, a little commercial break for two definitions. Two definitions of fit. So the first kind of fit, because we're going to start trying to diagnose kind of how we got here, and then we're going to go into what we do about it. First definition of fit, product market fit. So Steve Jobs famously said, you've got to start with the customer experience and work backwards towards the technology, not the other way around. Okay. So conceptually, that means if we have product market fit, it means we have a product that solves a real problem for real people, and recurring impact keeps those people coming back to use the product on a daily, weekly, or monthly basis. And the best way to measure product market fit, we can see it in dollar retention, but that's a lagging indicator. By the time somebody decides to unsubscribe from our service, the damage was already done 6 to 9 months ago. They were already shopping 6 to 9 months ago. So the leading indicator is usage retention. And there are lots of ways to measure usage retention. It depends on what kind of product you have. But quantitatively, we are looking for recurring impact, which we can see in usage retention, because recurring revenue is a function of recurring impact. So that's product market fit, best measured through usage retention. Go to market fit, lesser known, but still just as wise pundit, Jeeves Sobbs famously said, you got to start with the customer experience and work backward toward the GTM, not the other way around. In other words, we got to meet customers where they are. How do they want to buy? And quantitatively, the way we're going to measure this, conceptually, we need a scalable source of new customers that we can acquire reliably and economically. So that is something that is off in many businesses today. We had a way of acquiring customers scalably and economically and reliably, and then all of a sudden it was less economic. We couldn't get to those customers in the way that we used to, and so we're seeing and the way we're seeing that quantitatively is our unit economics are off. You can think about LTV to CAC as unit economics. We're going to talk about CAC payback because it's way easier to track. I spend $10,000 to acquire a customer. How many months do they need to pay me until I've paid myself back for that $10,000, after which I'll be making a profit? We want our unit economics to be less than a year, depending on the market. But 3 years plus is a really, really, really hard situation to be in, because I'm essentially financing that customer for 3 years. That's interesting. Okay. I had a slide in here that I think got deleted at some point. Oh no, here, let me go to it right here. So what we're looking for is, well, actually, I'll come to that later. No, I'll stay here. So we would want a 1 year CAC payback. So if you look at this slide, we spend X amount of dollars on acquiring a customer, and then we get ACV that gets us from that hole that we dug and builds us back up over the course of the year back to zero. That would be a 1 year CAC payback. A 1.5 year CAC payback. In the first year, we don't even get to zero. We're still in the hole. In our second year, about mid-year is when we cross over the line and we start to be profitable. A 3 year CAC payback, it takes us 3 full years of achieving annual recurring revenue before we're back to zero. So that's how we're thinking about CAC payback. All right. So product market fit, I've got a product that solves real value and I can measure that in usage retention. Go to market fit, I've got a scalable source of new customers that I can acquire reliably and economically. So what happened? What happened is we were being paid. We started spending $2.64 for every dollar of net new ARR, because even though we had achieved product market fit, we were now working on go to market fit, the financial markets actually didn't care how much we were paying for growth. We call this growth at all costs. So you pay $1 to get $1, great. You pay $2 to get $1 of growth, great. You pay $2.64 to get $1, great. We don't care as long as there's growth. So because the financial markets were willing to prop up our valuations and give us investment money to put into these growth machines, we were encouraged to spend more than is actually economic on this growth. And we kind of, instead of continuing to optimize this go-to-market fit, we kind of branched off and charted our course to an IPO on a growth at all cost trajectory, where what we would have liked to have done is keep working on that go-to-market fit and keep tuning that go-to-market for a $1 for a 1 year payback if possible. Now I see in the chat, what's an average CAC payback? It depends on your market. Some businesses won't work because of their retention rates won't work unless they can pay back in less than a year, like 6 months, 4 months for B2C companies. and some larger ACV products that have a longer implementation time and higher cost of acquisition actually do need 2 years plus to pay back. I use 1 year as just a way of thinking about it, as a very, very simple way of thinking about it. Hey, I'm a business person. I'm going to spend $1. I'd like to get that dollar back within a year. Otherwise, I'm spending investors' money, and I am turning into a bank for my customers. But it does vary depending on segment. So we have a choice to make. We could now that we've gotten back to free cash flow that is working, we could now go back and build the same expensive machines, which I don't think anyone wants to do, or we could build something that's more sustainable. I don't think any of us would, are pining for the days when we spend $2.64 for every $1 of new recurring revenue. We would like to build something that's more sustainable. We'd like to be less dependent on outside funding and more dependent on customer revenue. That's a more comfortable place to be as a CEO, because I'm not always catering to the whims of a financial market, and we'd like to fund our own growth. This is where we want to be. And by the way, over the long haul, we had a little bit of an anomaly over the last 10 years, but over the long haul, if you look at company valuations, we do need to be. Company valuations are more correlated to growth than they are to free cash flow. So this is Bessemer research. You've heard of the rule of 40. The rule of 40, which Bessemer actually made famous. If I can get my free cash flow plus my growth rate, add those two things up, those two percentages, and I'm over 40, I'm fine. Well, what that said in a growth at all cost world is, hey, look, if I had 50% growth and I was losing 10% on a free cash flow basis, I would still be hitting my rule of 40. 50 plus -10, 40, I'm fine. Or I'm growing at 20% and I have 20% free cash flow, 20 plus 20, fine. Or in theory, if I have 30% free cash flow and 10% growth, 30 plus 10, I hit the rule of 40, fine. Well, Bessemer just ran the numbers and they said it's actually not true. It's actually not true. In order to make the numbers fit the facts on the ground in terms of valuation, they correlated growth and free cash flow to company valuation, and they found that you have to overweight growth to have 2.5 times the weight of free cash flow in the equation in order to get the optimum fit of the curve to valuation. And they achieved a 82% R squared when they weighted growth at 2.5 times free cash flow. So it turns out growth still matters. Like this chart, not great. We've got free cash flow going up, but we have growth going down, not great. Free cash flow is only going to get us so far. The real driver, 2.5 times weighted versus free cash flow, is growth. So, we're not going to build enterprise value by generating free cash flow. We have to build our growth back in. That gets us to Act 2, how we build it back. All right. How did addressable and reachable market size develop? That's very specific to each market. And if you think about growth, I'm glad you asked the question, Sebastian. Think about growth. See if I can. Growth always happens on an S curve in all of our businesses. We're going to work for a while to get to product market fit. Then we're going to hit a scale phase where growth is accelerating, and then we're going to hit just the natural course of. And Sebastian, one of the things that limits this is addressable and reachable market. We're going to attenuate. Our growth is going to attenuate in an S curve. Well, how do you delay that attenuation? Lots of different ways. You can go into new markets. You can develop new products. You can develop new GTMs. But in any single market with a single product, with a single GTM, there's going to be a natural trend towards attenuation once that gets to maturity. And we're tempted, because we're addicted to growth, to go look for that new gear sooner sometimes than is reasonable. And especially in a growth at all cost world, we said, hey, we got one GTM working. How about two? Two's better than one, right? How about three? Three's better than two, right? And we add complexity into the business. That's fine as long as we have it as long as we have it well architected, such that each go-to-market has its own critical mass and its own well-defined processes, and it can tend to itself and run it while I go figure out the next one. But if I had a half-finished self-service go-to-market motion, and then I add an inbound go-to-market motion, and I half finish that, and then out of impatience, I add an ABM motion on top of that, and I half finish that, that's kind of three half-finished things adding chaos on top of chaos, and it gets very, very hard. So we do have multiple things going on here: size of addressable market, number of GTMs that I'm trying to run. And the question is, now that kind of the tide has gone out, we can't pursue growth at all costs anymore. We've taken cost out of the business. What do we build back? How do we build it back? And how do we get a handle on all of these complex and interacting forces? So the first thing that we need to do, most of us have done this, and really, for the CEOs on the call, lots of empathy. It was not. It is never easy to cut costs. It's never easy to have conversations with humans who are giving their heart and soul to our company, and now all of a sudden it's not going to work to have them at our company anymore. And I know we worked to help people land well. But it's just not easy. Doing that work, however, gave us Runway. And if we haven't done this work yet, we have to do this first. Paul Graham says default alive. I'm a big fan of default alive. Like current course and speed, can we run our business without dependence on outside funding for 2 years? If we can't, and we're going to depend on some sort of outside funding from the financial market that we know has been unpredictable over these last 2 years, we're pinning a lot of hopes on being able to predict what a financial market can do for us in order to bail us out. I would rather have 2 years of runway without being dependent on a financial partner so that I can go do the building that I need to do. So think about that. If you don't have 2 years of runway, are there things that you can do to secure 2 years of runway or close to it, but before either I turn cash flow break even or I need another cash infusion? And then the question is, so number one, make sure you have 2 years of runway and your default alive. And then the question is, what do I do with that runway? I now have 2 years to build. And we know we don't want to build back our expensive and inefficient go-to-market motions. Most of you voted for B, which means we are a little bit suspicious about how we're meeting the demand that does exist. And we've lost some of our go-to-market fit in terms of the motions we are running. So how do we build back? The next step is we want to look at our business by go-to-market motion. And you may look at this like SMB, mid-market enterprise. The way that it's depicted here is by motion, like a self-service, no-touch motion, a one-stage inbound motion, which would be like a one-call inbound close, a two-stage, meaning like an SDR qualifying and handing off to an AE to close, a medium touch. And then we get into the outbound high touch or dedicated touch motions for the higher ACV accounts. But however you look at your business, whether you have 1 GTM, 2 GTMs, 3 GTMs, have that conversation internally, decide how many it is, decide where to draw the lines, decide how they're defined, and then evaluate. We're going to look at each of these GTMs as its own business. because we want to know what we're putting into that business and we want to know what we're getting out of that business. And then we want to line them up. So what we're going to do is use this CAC payback analysis. And for our, I'm just going to say SMB, mid-market, and enterprise. For our SMB business, hopefully we're running that on the appropriate go-to-market motion, which is probably an inbound motion. For our inbound motion, what is our CAC payback? For our outbound motion, what is our CAC payback? For our ABM enterprise motion, what is our CAC payback? This can sometimes be complicated because it is hard for what I want to do to calculate CAC payback is take all of my marketing expenses and all of my sales expenses for that motion and then determine how many customers I was able to generate in the same period. So a quarter worth of spending, a quarter worth of customer generation. If I spent a total of $100,000 in all marketing and all sales, and I generated 10 new customers, then the cost per customer, the CAC, the customer acquisition cost, is $10,000. Now you say, well, what about my marketing expense that doesn't have anything to do with customer acquisition, like brand and creative? We're going to allocate that too. We're going to take all of our overhead, we're going to take all of our brand and creative, all of the shared expenses, and we're going to somehow figure out how to give it a home in go-to-market motion A, go-to-market motion B, or go-to-market motion C, and it does not have to be perfect. If it makes sense, divide it into thirds. If it makes sense to prorate it. But don't leave any dollars to the side that you're spending on sales and marketing. Charge those dollars to one of your go-to-market businesses. So we're going to look at every single one of our businesses, and we're going to analyze them, or our go-to-market motions, and we're going to analyze them as if they were a standalone business. And then we're going to step back and say, all right, so I've got 3 go-to-market motions. One of them has the shortest CAC payback by definition. One of them has the longest CAC payback by definition, and one of them is in the middle by definition. Okay, so now what do I do about that? I need to determine whether that long CAC payback, let's say it's over a year, let's say it's over 2 years, is something that I think I can fix. I may not be able to afford 2 years or 3 years, but can I fix it? And if it's not something I can fix, then I may want to figure out if those customers whom I was serving with that go-to-market motion could also be serviceable through a different go-to-market motion. Here's an example. Let's say I have an enterprise go-to-market motion. My guess is everyone here who has an enterprise go-to-market motion is feeling this pain right now. Enterprise outbound go-to-market motions tend to have the most expensive humans and the most expensive humans. We tend to have sales engineers, value engineers, pre-sales consultants. We tend to have AEs, managers, regional vice presidents. And when you load all of that expense, and also it tends to be pretty expensive, the events that we run, the partner networks, when you load all of that expense into that go-to-market motion, those tend to be the highest CAC customer acquisition, and they tend to rely on a very high ACV to offset that CAC. That may not be paying off right now. That may be, we may have a 3, 4, 5-year CAC payback right now for our enterprise motion. Could I still sell to those customers, but through a different motion? That's a question to ask. Could I do a smaller land, like a $20,000 land instead of a $200,000 land inside of an enterprise company? And could I do that all with lower cost and higher velocity sales motion? Could I? And then could I get that $20,000 land to turn into a $20,000 expand, and then another $20,000 expand, so that over time I'm still getting to where I need to get? It's a question. It's not a declaration. It's a question. We want to ask ourselves these questions about each of our go-to-market motions. If we've lost go-to-market fit in our self-service, why? Something happened in our competition for search terms. and we're paying too much. Something happened in our partner or marketplace marketing, and we're not getting as much attention as we used to get. Something happened in the competitive landscape, and we're not getting what we used to get. Okay, why? Can I fix that? Something happened in my mid-market motion. That's a two-stage, SDR to AE handoff, but it's not paying off. Why? Or something happened in enterprise where the ACVs are just too low to support my expensive go-to-market. Why? So we're going to look at each of these businesses as each of these GTMs as a standalone business, and we're going to evaluate what we keep doing what we're doing that works, and then what we're going to ask if we can fix. My opinion is if we have more than a 2-year CAC payback, that is a very, very suspect business for me. And I'm not sure we're going to be able to fix it within our 2-year window. And I would look at re-architecting that business. And I would love opinions on that from the group if you're dealing with the same things. Adding a GTM motion is a hard decision. Dismantling a GTM motion is maybe even a harder decision. But we need each of these businesses to contribute to our overall stack. So, Raphael, I see your point. At the same time, the growth at all costs taught customers, not us, that they could get every level of service for limited investment. So we want to reduce CAC while customers expect the opposite. That is absolutely true. And just to turn up the pain meter on that, Raphael, some customers and some businesses have been trained. Let me just take that to its extreme. That they can ask for anything, even custom development, custom features, custom integration. Almost to the point where for those customers, it's not a SaaS business anymore. It's a custom service business. So they're asking us for things. We're going to have go have a conversation with those customers and decide whether keeping that set of expectations in place is really worth it to us, or whether we're going to have to go reset. I think I heard someone come off mute. Maybe a comment on that. Feel free to pipe in.
We do have another question that was raised just above that one in the chat, Dave, about accounting from Arwa. How do you account for sales resources associated with renewals and not net new customers?
Arwa, yeah, thank you. Every business does this a little bit differently, but as long as it's sales, I count all sales expenses and all marketing expenses, even if they're to existing customers, as part of CAC. And then all increase in ARR, whether it's new or expansion, as net new dollar. And I net out the attrition. So that's the easiest way to do it. So if you look at the magic number formula or the LTV to CAC, that's generally how they calculate it. If we're only looking at new acquisition, then to DG's point, we're not going to count either one. We're not going to count the cost, and we're also not going to count the expansion revenue. So we want to match up expenses and revenue. I like looking at the business, including all expansion revenue and including all cost of expansion revenue, just to look at that customer set as an entire recurring revenue system. Okay, so now that we've decided if there's any businesses that are not savable, and we figured out if we can serve them in a different way, and I think there's some hard conversations in there. I've done this before, basically gone to customers and said, look, actually, you don't say, look, you say, I'm excited to introduce you to a new team. I'm excited to introduce you to a new motion. I'm sorry that we're not going to be able to deliver on some pieces of roadmap that we've talked to you about, but we are able to do this and just have those conversations. If they end up leaving, then they end up leaving. It may not be the worst thing. You might have read the book Angel Customers, Demon Customers. There is such thing. There's some customers that make you money and some customers that don't make you money. And in a growth at all cost world, we held on to all customers, but in this world, we may not. And as we try to serve all of our customers, but serve them with a different motion, we may lose some in the process. You're going to have to make that calculation. But we really do need 2 years of runway, and we really do need to rebuild a GTM fit the way we need to build it for our employees and our shareholders and our business. So we will so we'll have those hard conversations. And ARWA, sometimes CSM is put in COGS, often it is. You have to decide whether it's put in COGS or in cost of sales. And sometimes they get split down the middle. Sometimes you have 2 different roles, an expansion rep and a CSM, but there's no standard on that. People make decisions depending on the activities that their CSMs are performing and the way they want to represent the business. Okay, so now in a very exaggerated way to make a point, we have a decision to make.
Dave, can you reshare your slides?
Oh, yes, thank you. We have a decision to make. We're sitting here having reduced costs so that we can get cash flow back, but having not regained the growth that we wanted. We're no longer paying $2.64 for every new dollar, but we also are still not seeing growth. What do? So in a very exaggerated way, do we go after large enterprise accounts on a whale hunting expedition? Many of us grew up in a world where we could sell our way out of a problem like this. We'll just go get 2 contracts for $1 million each, and that will save this quarter. Or we'll just go get one $10 million contract. We'll spend a year on it. We'll spend 2 years on it, and that will, and we're already halfway into that. So let's not let go of that, and that will pull us out. That's option A. We can lean into the velocity business, meaning we're going to actually focus on a higher quantity of smaller contracts and get that flywheel going. Or BB, this should say C, do a little of both. I could change that on the fly. Do a little bit of both. It can be frustrating for many of us who grew up in a sales-led world. It can be frustrating and really tempting to go after this. And some of us have already spent a year trying to hold on to our enterprise motions and our enterprise teams, thinking that those deals would show up. And in 2023, there was a giant mirage in most of our pipelines, and we've analyzed a lot of pipelines. There was a giant mirage in most of our pipelines, which was these big deals. And then they didn't close. And we held on to teams, and we held on to opportunities, and we held on to plans, and we held on to targets based on an assumption that these large deals would close, and they didn't close. So it makes us cautious about betting on A, but at the same time, we're worried about betting on B because it takes a long time to build a business. So as tempting as it is to skip the tedium of building a revenue factory, extraordinary acts of heroism will never be repeated. In other words, if we're relying on extraordinary situations with the customer, extraordinary talent with a particular salesperson, an extraordinary result out of a certain team, whether we get it or not, if we get it, great, we survived another day. Can't tell you how many sales leaders say, look, I just got to survive another day. But repeating it is going to be the trick. Whereas if we go in and build the revenue factory, that by definition is repeatable. So let's talk about this. We've now taken the costs out, identified which businesses are producing and which ones aren't, and which ones we want to work on and which ones we want to retire. Hopefully we're not retiring more than one. That's very hard to do. And now we want to look at, how do I build up a revenue factory within the GTM motions that I want to keep? So number one, I want to systematize all my human-led actions, meaning I want to design processes and train people. I want to design processes and train people. We are not hiring people and then asking them to set their own processes. We're not hiring people and who are going to bring in a system from somewhere else. We're going to design the processes that work for our business. We're going to test them. We're going to iterate on them. We're going to keep what works. We're going to retire what doesn't work. And we're going to train people to execute our processes. If people are not executing the process that we designed, then we're not testing the process that we designed. But if we can test the process that we designed, then we can know when it works and when it doesn't. Then we can know when to keep it and when to retire it. So we want to design processes and train people. Then we're going to manage the process and lead the people. And this is very counterintuitive for many kind of charisma-driven sales leaders, which many of us are, who think that we can manage, basically hero our way out of these problems. We're going to design and test processes. We're going to train people to execute them. Then we're going to test those processes and see which processes work and don't. We're going to hire and fire processes. As long as the people are executing to the process, we're going to hire and fire processes, not people. And we're going to improve processes, and we're going to lead people so that they can execute against those. This is the very, very fastest way to get a flywheel going in a velocity business, but it is not the most reliable way. So you want to go put something into production tomorrow, train a team on it today. It can literally go into production tomorrow. It's the fastest thing. But what about the day after tomorrow? And what about the next week? And what about the next month? What if I train them on A tomorrow and B the day after tomorrow and C the day after that, and then they start forgetting A? That's just human nature. I'm working with human-led actions. I'm going to have some unreliability in that. Even though it's faster to get into production, it might be less reliable. Number two, which takes longer but is more reliable, is I'm going to automate anything I can. Let's say that I figure out that process A works. I'm doing process A 100% of the time, and it works 70% of the time. Would it be doable in an automated way? If it is, why wouldn't I automate it? Why wouldn't I either get AI to do things that humans used to do? If it's the same thing over and over every single time, why wouldn't I get AI to do it? Or if I can program it all the way into the product, why wouldn't I get the product to do it? If it's a canned demo, why wouldn't I get the product to do it? If it's a if it's a renewal and all I needed to do is change the expiration date, why wouldn't I get the product to do it? If it's an expansion and all I need to do is authorize 3 new servers or 4 new seats or this much extra compute, nothing else in the contract changes, why wouldn't I allow that to transact through a portal in a self-service way? These things take longer to build because you have to actually build them into technology. But once they are built, they're more reliable. So the human-led processes are faster to put into production, but they're less reliable. The product-led processes are slower to put in production, but they're more reliable. And I want to do both. I want to optimize my human-led process actions, and then I want to automate anything that I can. I want to do both. That is going to help me build a revenue machine. So, in fact, a friend of mine at Zoom said, and I think I see this from Tim, better to have 100 guys doing 1 to 2 deals than one guy doing 100. I had a friend of mine at Zoom said, I like to teach my teams to do 100% of the time what works 70% of the time. I would like to teach my guys to do 100% of the time what works 70% of the time. And it seems logical, but often we we default to a mode where we want it to work every single time. We want it to work 100% of the time. So then we deviate from the process and we do special accommodations and we make special promises, or we run special processes off to the side in order to chase that great white whale. If we can just get teams operating in a system, then we can test the system, manage the system. So to summarize, no time like the present. We are actually in a very interesting spot where we've got our free cash flow fixed, but our growth not fixed. And yet, the main driver of company valuation is growth. So we have to fix it now. No time like the present. We need to get 2 years of runway because it's going to take us some time. We're going to build back. We're gonna build back a GTM, but we're going to build it back the way that we want. We're going to assess what we have today, and we're going to eliminate anything that we think is not fixable within that 2-year runway. And by the way, it's tough. You know, the more people you have to hire, the more people you have to train, the more ramp time you have to accommodate. You know, the longer it would take you to fix something. So it may be easier to retire a GTM and just work on your remaining 3, or retire a GTM and work on your remaining 2. Then those remaining 2, we're going to build as if it were a factory. We're going to work on the processes and systems for the human-led motions, and we're going to automate anything that we can. We're going to streamline those, define them, and then once we've got all the human stuff defined, we'll automate what's automatable. Guys, I really appreciate you joining. Staying smart on this stuff is easy to do. There's a lot of people talking about this. Winning by Design has a voice. You can follow us and subscribe to the newsletter at the URL on your screen. Also follow us on LinkedIn, and you can attend additional workshops. Thank you so much for joining, and please, we would love to be a partner in any of what you're trying to do to get growth to show up in your business the way that you want it. And go be amazing. Thank you.